So we're going to have a great conversation this afternoon, right? Talking about the second act of impact investing. In some ways, the first act isn't even over, right? We actually don't know the outcomes of the first act yet. And yet there is so much enthusiasm and energy in this that we got to figure out what we're going to do next. And incredible questions of scale. How big is this, right? And what are the strategies and choices we have in this space? What are market returns? Should we demand market returns? What's the scale we should get there? To what degree do we want to sacrifice or think about that differently for the work to have larger impact, right? The other questions of pipeline. How do we have enough pipeline to get into this world, right? What are we doing on that end, right? And then on the other end, we have all of these partners and people who have been on the sides of this that are ready to get in various ways with a whole set of their own questions about what it takes to be part of this dialogue and to be part of this movement. To some, this is an alternative to CSR. To some, this is an entire different way of doing business. So we have a lot to talk about today. What we're going to do in the next few minutes is hear from 3 speakers. We're going to talk a bit about their work and help frame the conversation for us. And then we're going to turn it back over to this room to talk about what are you learning, what are the questions you have, and what are we going to do in this second act as the first one keeps rolling on. Okay? So first, Matt Bannick from Omidyar Network. Please share some thoughts with us. Thank you.
Thank you. Thank you, Alexander, and thank you, everybody, for joining us this afternoon. I'm going to share some thoughts about impact investing, but I've been asked to share them in the context of a commitment that Omidyar Network made several years ago. So I'll walk you through that commitment and some of the lessons learned. And as we go through that commitment, hopefully we draw out some of the lessons from impact investing. And then I'll be turning it over to Tracy and to Andrew. I have huge esteem for both of them. In fact, I have so much esteem for them that Omidyar Network has invested both in social finance and LeapFrog. So I'm sure they'll share some fabulous insight. And I also know it's terrific that CGI is taking on this issue of impact investing, because I think it does hold great promise for having huge social impact in the world in a very scalable, sustainable way. So at Omidyar Network, we consider ourselves a philanthropic investment firm. We're a philanthropy, but we engage in the world through investing. And we invest in early stage organizations that we think can scale up and have a massive impact in the world. Now, our primary investments are in individual firms, but our broader objective is to move entire sectors. So we complement our investment in individual firms with grants in organizations that help create a more vibrant context in which those firms can scale up. And to date, we've invested over $630 million, split almost equally between for-profit and not-for-profit organizations. We've invested in India, Africa, the US, and Latin America. Now, in 2010, we made our, 11th CGI commitment. It was a $25 million, 3-year commitment dedicated to, quote, unleashing opportunity through mobile technology. And I'll share a few lessons learned. Now, we're bullish on mobile for a lot of the same reasons I think that everybody in the room is. It's ubiquitous, empowering, and potentially transformative to lives. Now, since our work in mobile is so broad, I'm going to focus specifically in mobile money and talk about some of the lessons learned in mobile money. Context here. There are 2.5 billion people who lack access to formal financial services, who are out of the financial mainstream. 2.5 billion. Now, 1.7 billion of these people have mobile phones. Huge opportunity. If you lack access to financial services, things like credit, insurance, savings, it makes it more difficult to move ahead in your lives and seize opportunities. Mobile money can bring people into the financial mainstream. How many people here have heard of M-Pesa in Kenya? Show of hands. Right? And I suspect there are a few bashful ones that kind of heard of it anyway. But M-Pesa is this remarkable success story of mobile money in Kenya. 30% of Kenyan GDP now goes through M-Pesa. And behind those numbers are an incredible, large number of people who now have improved livelihoods, who can send money home to their family so their family can feed their kids and send them to school. But mobile money is more than just M-Pesa. There are now 6 mobile money deployments in the world with more than 1 million customers. So this is really beginning to scale. And we're delighted to be part of this movement. We've invested in 3 terrific organizations companies in the mobile money space. One is Rumah in Indonesia, and I'm delighted that the Rumah CEO, Aldi, is here in the front row. We've invested in a company called Paga in Nigeria and Zuna in Zambia. Now, Indonesia, I'll show you, there is Paga, and we have Zuna. Now, all three of these markets are like Kenya, right? They have really high mobile phone penetration and very low levels of financial inclusion. In our work in mobile, we've not only invested in these firms, we've also, as I said, invested in the broader infrastructure that will help the entire sector move forward. So now I want to give you a couple quick lessons learned. And here are the four. Number one, early stage investing is challenging but highly catalytic. So go early stage. Number two, robust infrastructure helps accelerate growth. Number three, policy, absolutely critical. And number four, and is particularly excited about mobile money, one sector success can actually accelerate the development of other really high impact sectors. So quickly, number one, early stage investing. There's been a legitimate concern, Alexander mentioned this at the outset, of a lack of deal flow in impact investing. But that picture can radically change if impact investors build tolerance for early stage risk into their models, right? It's not easy. Our investments in Rumah, Paga, and Zuna are all early stage, and even with all these exceptional capabilities, still high risk. But it's precisely these stage investments that can drive the highest level of innovation. It's much easier to invest in established businesses with predictable returns. I think it's less catalytic. So going early stage is particularly important. Important to note, early stage approach requires a long-term time horizon. Also in turns, it requires essential human capital support. So what do I mean by that? Early stage entrepreneurs frequently lack expertise on a whole host of areas, right? How do you hire the right people? How do you scale an organization? What's the right marketing plan? Even basics of a business plan. How do you pitch your model to potential investors? So early stage investors need to get in there and be committed to that organization's success and do everything necessary to help them scale, and that is time consuming and expensive, but again, highly catalytic. By the way, this doesn't need to be just a private sector game. I think there is a role for development organizations, for philanthropists, for the public sector. It's important to note that with M-Pesa, the seed funding from M-Pesa came from DFID, the US development agency, and a public-private partnership with Vodafone. So room for everybody to play in early stage investment. Number two, robust infrastructure and knowledge accelerates growth. Firms don't exist in isolation. The broader environment can have a profound effect on the ability of a firm to scale up. In rapidly emerging sectors, critical knowledge of sector evolution and promising opportunities is often scattered or non-existent. Now, to address some of these issues in mobile money, ON and others have supported the Mobile for Development Intelligence, or MDI, efforts of the GSMA. So the MDI is helping accelerate the market by sharing critical industry intelligence and helping mobile operators understand great business opportunities that also help advance a country's social and economic agenda. Again, all sectors have a critical role to play in developing the infrastructure. Third lesson, policy critical, right? No, policy is generally critical in the development of any sector. It's particularly important in mobile money. In fact, many have said that appropriate regulation is the single most important factor in laying the foundation for effective mobile money deployments. And one of the things we've done on the policy front is we've supported a public-private partnership called the Better Than Cash Alliance, which is helping governments establish the right policies and the right environment to take a lot of their cash transactions and make them digital. Just one quick example, in Afghanistan, the police force, when they're being paid by cash originally, when they shift to digital payments, every police officer got a 40% increase in their compensation. 40% had gone missing. You go to digital payments, more efficiency, less corruption, more money in the pockets of the power than people that need them. Finally, one last lesson learned. One of the reasons we're excited about mobile money is it helps accelerate the development of other sectors. I'll show you a quick slide. It's a little complicated, but just real quickly, some of you might have to turn around and look behind you. But here you have a population, the total population of a country on one axis, on the horizontal, and the number of mobile for development deployments. That means deployments that specifically help advance development. And each of the triangles there represents a country. And the best fit line is the number of mobile deployments you would expect given a country's population. There are 4 outliers. One is South Africa, separate explanation. But there are 3 other outliers where you see exceptional development of mobile for money deployments. Each of those 3 has a really strong mobile money deployment. And the logic here is pretty simple. If you have a mobile for development deployment, and you can actually charge, you can use that revenue to scale become sustainable and to scale the organization. So absolutely critical element of mobile money is it builds others. Quickly wrapping up, key takeaways. Early stage investing is challenging but highly catalytic. Robust infrastructure is important. Policy is critical. And if you get it right in one sector, you can help accelerate additional sectors as well. So thank you very much.
Thank you, Matt. Great. And again, so much in there, so thank you, Matt. And lots of topics for our conversation. What are we going to do to change the risk profile and the risk tolerance as we go into this? What is the scale that we're going to do this at, right? As he talked about, how do you have a good investment and do everything for the enabling environment around it? The choice of investments in that is difficult, right? And so there's lots of lessons learned. I want to get to it quickly. So Tracy, please, from Social Finance, want to give us some other thoughts. Thanks.
Great to be here, and always a hard act to follow, not least my funder, Matt Bannick. I'd like to tell you a quick story, the story of Gary. Gary is a 50-year-old Brit. He's basically spent his whole life alternating between time on the streets and time in prison. His life is pretty grim. He would panhandle on the streets, go back to prison. When he gets released, get back to his old drug habits, and then go back to prison again. His whole life was basically relying on 3 systems: the court system for emotional support, the emergency room for basic primary care, and the prison system as his housing system. And that is completely unsustainable, not only for Gary, but also for society, as well as for the taxpayers who actually foot the bill in healthcare, in public safety, and other agencies. Now, Gary enrolled in a reentry service program in the fall of 2010. He was met at the gates. He was given basic needs. He was encouraged to open his first bank account. He was encouraged to take some cooking lessons. And 3 years later, he has not been to prison once. And the interesting thing about the story, and what is unique about the story, is that the reentry program that Gary is enrolled in is actually not particularly unique. We have them not only in the UK, but many very successful programs in this country. But the very financing of that program is what is unique. This program wasn't funded by a government contract. It wasn't funded by philanthropy, but it was financed by the world's first social impact bond, pioneered by our sister organization, Social Finance UK, in the fall of 2010. So I was moved by this in the late 2000s and decided with my co-founders, Sir Ronald Cohen and David Blood, and with the great support of Matt at ON, as well as from the Rockefeller Foundation and the Pershing Square Foundations and others, to start social finance in the US to bring this innovation to this country. And what does a naive social entrepreneur do? She comes to the Clinton Global Initiative in the fall of 2011 to make the following commitment, to launch the US social impact bond market and to see a $100 million US social impact bond market take flight in the next few years. Now, for those who know about the space, we sure do not have $100 million worth of social impact bonds to date. And in fact, there's only been one social impact bond issuance, a $10 million issuance in New York City around juvenile justice issues on Rikers Island. What are the challenges that we face? In order to really appreciate the challenges, you really need to understand the core of the power of the social impact bond model. It is really about partnerships. It brings together several parties that are not quite used to working together. It involves the government. It involves private investors. It involves nonprofit organizations. And you bring them together in an arrangement, a contractual arrangement, in such a way that financial value is delivered and social value is delivered. in the case of Gary, we have a contract with the UK Ministry of Justice that if our Garys in the treatment group does not beat the control group with a very rigorous evaluation methodology, by 7.5%, our investors actually lose their money and the government owes nothing. But if we can meet that threshold and lots of Garys get rehabilitated and lead productive lives, our investors could earn up to a 13% net return, which is paid for from government savings when people are not hitting the ER system, when people are not getting locked up. Now, lots of moving parts in this arrangement. And the challenge of articulating a framework that would allow government to enter into these contracts, a legislative framework to think about how to pursue these opportunities, cost-benefit analysis framework to think clearly about the fiscal implications and not to create perverse incentives and generate unintended consequences, are very complicated, and I hope we'll get to talk about some of this. But also from the investor's perspective, ultimately what we're trying to do here is to create a financial market for people to invest in social outcomes, and the risk assessment framework simply isn't there. How do you actually price risk? How do you think about operating risk that investors are asked to take on? How do they think about whether a nonprofit actually have the capacity to scale? Whether the past track record could be replicated on a consistent basis? How do you think about operating risk? Such as, when the person actually gets handed from the parole officer to our program, what are the operating linkages to make sure that things don't fall through the cracks? And finally, credit risk from government. How do you actually measure the strength of reappropriation and that future administrations would actually honor this commitment that a former governor has committed? So all these things are what we worry about a lot at Social Finance day and night. We're very excited about the power of this instrument. What's really incredible is that in the last 2 years, what we've learned on the ground is that that commitment that we made 2 years ago, in this building, is that the challenges are far greater than we ever imagined, yet the promise is also far greater than we ever imagined. The market size for this instrument is huge. Matt talked about sector-level approaches. The social impact bond is precisely a platform level to mobilize more investment capital to connect the social sector to the capital markets so that social challenges can be addressed at scale. Talk about market size, right? We talked about recidivism and Gary. We spent as a country $70 billion on incarceration alone, and this is not unique to the United States, although we do have the largest share of the global inmate population. That in itself, that vertical, reentry, cutting recidivism, is a multi-billion-dollar market. We have a project that's happening on the ground in Fresno, California, where we're piloting whether retrofitting the home environment can contribute to better outcomes for asthma patients. That alone is a $50 billion problem for this country when kids and adults recycle through the emergency rooms because what the PCP could give this person is simply an inhaler and not really addressing the root cause of the problem, which is retrofitting the home environment and getting rid of the allergens that trigger the asthma attacks. Each of these vertical, whether it's recidivism, whether it's chronic illness management, whether it's better maternal care for low-income, first-time mothers living in poverty, each of them are really, really large. And what is beautiful about the social impact bond is that it is possible not only to create economic value while delivering social value, it is in the very deliverance of social value and the betterment of the individual's life can economic value be created, which is very much consistent with the shared value approach. I see Mark Kramer in this room that he and Mike Porter pioneered. Yet, we have a long road ahead of us. There are certainly lots of challenges and lots of promises. Frankly, I think we need to be experimenting a lot in this field. We need to develop a lot of proof points so that we can learn rapidly and begin to standardize some of these practices, risk assessment frameworks, legislative frameworks, policy priorities. And you are standing next to me, and I will finish. But what we feel palpably, in particular in the wake of the financial crisis, is that there's just never been more interest among the financial community, and there's never been a more opportune time to rethink what the capital markets can do for our society.
Great. Thank you, Tracy. And I know in this room there's a lot of questions about the size of social impact bonds and the learnings that you've been through to sort of get it to here. I mean, I think the scale of this is huge, and there are lots of dependencies that you've figured out and we want to figure out together. So I want to get to the conversation. So Andrew, maybe you'll round out our thoughts and then we can get to the dialogue from LeapFrog.
Two great acts to follow. Well, I'm not here really to talk about a better way to do philanthropy. I'm here really to talk about a better way to do business and investing. We've always felt, a lot of us working in the financial markets, in businesses in emerging markets, that there are an enormous number of inefficiencies, that businesses could be more mission-driven, could do more. We've also always felt that capital could be mobilized for better ends. But we've also always confronted a whole set of problems around alignment of the business for financial reasons. What are the best metrics to drive your business? How to create outperformance? And I think part of the promise that we've been speaking about here is that those two things can be brought together. What LeapFrog did 5 years ago was come to CGI and say, we are going to solve a particularly big social problem with a very effective business. And that problem is that low-income people, what we would call emerging consumers, partly because we believe they should be treated as agents, not as subjects, beneficiaries. Low-income people do not have safety nets. They don't have insurance. They often don't have savings. They often don't have pensions. And all of that changes your risk architecture very fundamentally that's in your head. You may have a worthwhile opportunity as a farmer to triple your income, lift your family out of poverty with a particular seed or drip irrigation, and you choose not to take it because there's a tiny chance of failure. But as a business, something that's very, very likely to succeed and has a low probability of failure could be a really good bet. You could insure those people. So we thought, how do we, just to start, help insure 25 million people in Africa and Asia? And we decided to raise $100 million for what was our first commitment, which was to raise the world's first microinsurance fund and to deploy it to reach those 25 million people. It was a week after Lehman collapsed. President Clinton stood up and said, we're going to create an asset class that doesn't exist in the face of the strongest headwinds in 70 years in the finance markets. I'm happy to say, with quite a lot of pain and anguish, but we raised $135 million. And today, LeapFrog is a $340 million institution. We reach 18 million people through our portfolio companies, of whom 11.9 million are low income. So if anybody tells you that you can't achieve scale in impact investing or in social business, they're just empirically wrong. Now, that doesn't mean that there isn't a need for a different kind of approach to serving these markets. It doesn't mean that you don't have to find quite distinctive businesses and provide them with really significant support of an operational kind. But it does mean that you can have businesses and intermediaries that are purpose-driven and that outperform their conventional peers. And that is tremendously exciting for the many people in the room who have always sought money and meaning, profit with purpose, as we call it. Because you can be whole people. You can put those two sides of yourself together. It's no longer the small and social and big but meaningless financial. It's no longer Mother Teresa or be Donald Trump. You can find some other alternative way to lead a meaningful business life. And I think there are a number of lessons that we've learned along the way. One thing is there is a profound role for early stage capital, but there's also a profound role across the spectrum of capital provision So we often find a business that will reach 1 million people, and we'll say, this really works. Why can't we scale it to 10 million or 50 million people? We'll often find a business like, say, Mahindra or Shriram, two of India's leading conglomerates, where we're invested in subsidiaries of those conglomerates that provide insurance and financial services to low-income people. And we'll say, well, we can provide you with capital, but more importantly, with expertise that comes from operating across the 13 markets that we do, in how you do product design to reach ever lower income people, in how you broker distribution in the right way, manage regulators in the appropriate way, mobilize your staff and your agents around ethical selling. And they'll say, wow, that's really interesting. And we have this vast reach into India. Between them, they reach over 10 million people. Into rural India, tier 4, tier 3 towns. And they see in this the opportunity to unlock the rest. Now, is it good business to do business with two of India's top 20 conglomerates that are enormous providers of financial services across these societies? Of course it is. And our companies have done very well. Last year, on average, the revenue growth in our companies was 24.7% across the portfolio. So we've learned some lessons around putting profit with purpose together. One is provide a lot of operational value add. Another is don't just do tick box reporting after the fact on the social, because then the business gets run, and at the end of the quarter, an analyst ticks through about all the things that are social and nice. Instead, think about an integrated framework. We have developed a framework called FIRM that reports on financial, innovation, impact, and risk management together, that can be used as a dashboard, ultimately, by chief executives and management teams to drive performance. So if your renewal ratios are down, someone's not coming back to buy the policy again. Well, that's bad from a business perspective. It's much easier to keep a client than to get them. Much more expensive to get them. It's bad from a social perspective because of course people are not buying your product because they're not finding value in it. And it's bad from a risk management perspective because you're constantly losing your book of customers. So there are all sorts of metrics out there that you can draw upon that help you to drive all the dimensions of the business. And that when you manage to those metrics, you manage towards a synergy of profit and purpose. And you achieve a certain kind of outperformance, sustainability, and excellence for the business. We have been working on things like launching a health product with Mahindra. I used to, and still do, and occasionally back early stage social entrepreneurs in the non-profit space to try and reach these kinds of results. But I must say, the Mahindra experience has been revealing to me. We launched designed a health product and launched it through their system. And within 6 months, in the pilot, 50,000 people were covered. Right? So, and now they're the 10 million others that Mahindra could reach. 2% of India falls into poverty each year because of health events. 2%. That's more than all the people in Greater New York. Now, what's going to get them health insurance and the ability to go to the hospital really fast? Government's not going to be able to provide it swiftly. Non-profits are going to do incredibly important work. But if you look at the likes of the Mahindras, the Shrirams, that's the low-hanging fruit for reaching the first, say, 2 or 3 or 4, 500 million people with health insurance. Now, again, I just want to stress it is an ecosystem. Different players play a different role in this ecosystem. We're one player, a growth investor, a private equity group that is able to raise significant capital from the financial markets. And we've got the likes of MetLife and Pru and Swiss Re and Partner Re investing in LeapFrog and JP Morgan. And there are many other roles to be played. There's no one ideology, one place that's the true place to play a role in this ecosystem. But I do want to encourage people to think about scale, think big, drive innovation through big businesses, not just small businesses, because then you can launch multiple experiments, so there are different ways to drive it, and see that profit and purpose are a synergy. And let's get beyond this very naive view that there's non-profit and for-profit. Let's get to a point where money and meaning come together, and a very different kind and better kind of catalytic capitalism is practiced by all of us and by the financial markets. Thank you.
Thank you. Thank you. So we have a sense of the scale, right? So what questions do we have? What choices have to be made? What are the ways to get other partners on board as we're building Mother Trump? Right? What questions? What are the hard, people are working pretty hard on it. These are complicated deals. So what are the lessons learned? What are you thinking about? Yeah.
What is Jorge Camil from Mexico? Talking about scale, sometimes social problems, the user you're giving a service to does not have enough money to pay for the kind of services he needs, whether it be health, whether it be education. In some cases, the government can help give scale if you convince them that you can do something better and cheaper than them. So the question would be, what is the role of government in developing countries to achieve this scale when the end user does not have enough money for it to be a fully sustainable business?
Right. Who wants to take up that question of either government partnership, or when is it market prices, when is it subsidized? Who can help us think about that question? Please, back here.
Thank you. James Mwangi from Dalberg. What we found is that when it really depends on where the value sits in the social intervention. And there's some situations where, for example, if you educate someone, you're creating an opportunity for them to earn value. A lot of the value will sit with them or with their employer, etc. In other instances, a lot of the value is in the externality, and it's in helping government understand where are those spaces where certain social goods will be underprovided unless the government creates that additional oomph. We're working right now, following on the example of the social impact bonds in the UK and here in the US, on trying to support the creation of a malaria social impact bond in Mozambique, working with the mining companies and impact investors. And what we're finding is there's clearly a role for government there, because at the end of the day, the private benefit to the mining companies from lowering the prevalence of malaria is substantial, but is not sufficient to cover the cost, or we're not capturing the full vast benefit to the broader population, to the broader country. So it's about understanding where the externalities sit, and then pushing, getting government to understand that this is a much more cost-effective approach. And I don't think it's easy, but I think increasingly in developing countries, you are finding government counterparts that are ready to have that discussion. If I may, I also did have a question, but I don't know if I've lost my chance to pose it.
You have the microphone right now, so why don't you
All
go
right,
for it?
well, possession
Not
being
that we
9/10
want to set
of
that
the
as a norm for the rest of this conversation. Yeah.
possession being 9/10 of the law. But something, Andrew, your points around profits with purpose were powerful. And one thing that we're certainly observing in the work we're doing with corporate leaders is very often impact investors think about their job as finding the social business, investing in it, and then waiting to see what the result is. Where we're seeing really interesting results is where the impact investor takes advantage of sitting on a board, works with the management of the company, and recognizes that most investing doesn't happen when you buy equity in or sell equity in a company. It happens every day when the CEO and various business line heads are deciding what to invest in, what to dial back from. And unless you exercise voice in that and say, well, I want you to optimize across a number of things, you end up with suboptimal performance on one or multiple dimensions.
Okay. Yeah, please. Didn't end up as a question, it was more of a statement, but please respond.
Yeah, I think that points to a few key areas. First of all, we have to see people as emerging consumers that need to be served, and that even if they have a few dollars a day that they're earning, if you can get them a 60-cent insurance policy that covers them to a $1,000 payout through mobile telephones or through other very smart techniques, that's incredibly powerful. But secondly, you were talking about sitting on the board. I think goes far beyond the board, and you then spoke about management. We invested in a company called Express Life, and it turned out that in Ghana there are only 7 actuaries, and we have 3 actuaries on our team. So we sent them over to Ghana, repriced everything. It wasn't rocket science from an actuarial perspective, but it was a very simple set of technical solutions, and we were able to drop the price of the premium by 30%. And increase the payout to the customers while increasing the profits and the revenue. And That was not because we had some genius that we'd come up with that we could report in Harvard Business Review. It was because we essentially could apply a set of technical skills that when we arrived, we could provide some help below the board, not just on the board. And so increasingly, I want to encourage people to think of the below the board efforts, and it's one of the things that Omidyar Network does incredibly well, providing support around human capital, around positioning and marketing, around thinking about all those dimensions, as well as the more technical areas like actuarial help.
And part of what we know is there's a bunch of technical fixes, and we want to focus on those, and there's some things we have to invent. And so let's see if we can. There's a comment in the back in the middle, yes. Right over there.
Sanjay Bhatnagar from Water Health. We run a market-based model for providing decentralized water purification. I wanted to address the comment about the question, when is it appropriate for the government to intervene? And I think the concept I want to talk about is price discovery. In these markets, there is a lot of, especially when we talk about the bottom of the pyramid and helping the poor, there's a lot of desire to give things away. And the challenge there is, if you're not careful, you might impact price discovery. And if that happens, then you will impact the ability of the private sector to really make any sort of impact in these markets. So if you think about how the government should subsidize, the right way to think about it is perhaps at the individual level, so they can buy the goods and services at market prices, and not get into a situation where the delivery price of goods or services is directly impacted, making them unsustainable.
Right. Other comments? Yeah, up in front here. It's coming to you.
Hi, my name's Andy Bannick. I'm from South Africa. And I run an NGO in South Africa that works and focuses on shanty upgrading. And we link to Shack Dwellers International, so we have a development agenda. But also in the organization I run, there's what you're saying about financial sustainability. And we have two products, one that we haven't done yet, and this is for Andrew, which I would really encourage you and would hope that you would work with us on. But the first one is we have a loan finance program. And people who want to upgrade and improve their shanty can come to us, and we will provide and build a better shanty for them. And that's not linked to our development agenda, where we change the whole layout of the settlement and link it to government and different resource flows from the state. This is individuals. So we can also address people that don't form part of our broader programs. But another idea that I've had for quite some time, and we also respond to disaster and to issues related to resilience. And we have to raise funds for this. And in South Africa, you have a situation where, and I'm sure this is for most parts of the developing world, where you have floods or fires, and it just wipes out an entire community. At the beginning of this year, there was a fire that 800 shacks were burnt down, displacing 3,000 families. We had to raise $150,000 to build 90. And that's resource, we got to go out and we need to find those resources. And then we do it on a more regular basis on, if there are 5 shacks here or 10 shacks there. But an idea that I've had that I really would like to work with you on is that through our networks that we work with women-based saving schemes, so the idea of capacitating and engaging women to lead the process, to see how we can actually link that to insurance. But insurance for disasters like informal settlement and shanty disasters. So if you could assist us there, okay. I think
we don't want to turn this into a pitch session, right?
Sure.
Right? But these are good ideas. So Matt, when you hear something like this, what are the 2 questions that go through your head about whether this is something to consider? What would you need to know? Again, we're not going to make this into a pitch session, but what are the considerations, given the volume of stuff that comes at you, that distinguishes what's worth taking on now?
I actually think she was pitching Andrew rather than me, but but I'll still take it. From our perspective, we look at whether an idea is scalable and sustainable, and whether in fact you can have significant impact with a relatively modest investment, and whether that investment can be perhaps recouped over time, and also whether that, if it's a grant, again, accelerates a broader sector. So that wouldn't, something like the stuff you're working on, I think, is incredibly important, wouldn't necessarily be a great fit for our work.
Okay, great. Yes, coming up front here.
There's an enormous
microphone.
Oh, sorry.
Yeah.
There's an enormous opportunity here, I think, for nonprofits to work with nonprofits in the healthcare system in the space that I'm involved in. 80% of the healthcare institutions are nonprofit. 30 years ago, I had to start a for-profit incubator and a nonprofit 501c3, so the 501c3 could work with government and with the academic institutions. But this new vehicle gives you an enormous opportunity to participate in improvement, for instance, in healthcare. 30 to 40% of our cost, and across the country, across the world, we harm about 1 in 10 patients. And particularly women and families can have a dramatic impact on the cost of healthcare. And yet for-profits can't really work with nonprofits very well or with governments. And my question is, are you leveraging the opportunity of your nonprofit working with nonprofits and working with governments and putting some of the money in performance improvement where we currently have a lot of barriers in the structures? I think there's an enormous opportunity there, and the question is, are you leveraging that?
Anyone in the room can answer it. I don't think there has to be anyone up here. Anyone who's working on this, you know? The challenge, these are partnerships at such a great scale that we've never done many of this before. And traditionally, nonprofits are not good at working with each other, right? So who's wrestling with this challenge?
Ultimately,
yeah.
Alex, if I may,
Please.
Cross-sector partnerships is hard work, and there's kind of no set of prescribed way to ensure success. In our limited experience working at the intersection of government, nonprofit, sometimes for-profit, and investors who are clearly private in nature, I think the willingness to compromise is probably one of the most important characteristics in a successful public-private partnership. And what does it mean to compromise? Is to individually understand the motivations and the preferences of each of the parties. And for someone like us sitting in the middle as kind of an intermediary or a social investment bank of sorts, is to translate, is to find the common spots, is to kind of de-risk certain things while enhancing the return to others. But ultimately, the message that we keep saying to our cross-sector partners is that once you've expanded the pie, right, and created social value and financial value through betterment of lives, there is still the very act of dividing up the pie. How do you split it up between the government and investors, for example? And there are many other ways to talk about division. What we keep saying over and over again is it doesn't matter. Everyone needs to compromise, but the only constituent that does not need to compromise and the ultimate winner in this whole arrangement is society. And that message is highly resonant to all the parties and has been a very important way to move lots of conversations forward.
Sure.
Alexander, if I could just underscore.
Sure, go ahead.
I think a lot of people talk about public-private partnerships, and it's a great buzzword, and every kumbaya, and isn't this great, we should all work together. And they can be incredibly powerful, but underlying them, and Tracy was, I think, touching upon this point, was aligned incentives. What is each party getting out of that, and being crystal clear going in so that you get commitment from each party up front to make it work, right? And so we sometimes overlook the centrality of incentives.
Yeah. Right. And aligning incentives it's an evolutionary act, right? I mean, that's not the easiest work to do, but yes, comment in the back.
Hi, Alex Eaton from Sistema Bielbosa. We're based out of Mexico, and we have been on the receiving end of a lot of some different impact investment vehicles and a lot of different offers. And I guess just getting back to the core of this conversation, we've been pretty underwhelmed by the offers that we've been receiving sort of in this new space, and found that a lot of really traditional impact vehicles have put social in front of their name. And obviously it sort of comes down to this risk profile that a lot of you guys have talked about. I was fascinated that Bill Gates was talking about philanthropy trying to take some bigger risks, and that's actually sort of counter to what they do currently. A lot of the donor organizations tend to be really, really conservative in where they potentially have a larger, they're not looking for returns, so they potentially have a larger margin to take big risks that So I guess my question would be, working with you all, what are you guys doing to potentially absorb more risk or create collaborations? Because I don't really feel like the entrepreneur is in a great position to help lower risk. We can talk about it a lot, and we tell you the confidence that we had. We're overly optimistic group, but generally speaking, we can't really lower the risk for you. So I really get excited about the social bond models. I like the idea of philanthropy coming in to fill some of these risk gaps. And then the other sort of piece of that is that I feel like we also tend to, or we were specifically, over-optimistic about scale. We've got these great ideas. Why wouldn't 1 billion people want it, even though 100 have it today? And so, and you know, I still say that, and I've been saying the same thing for a couple of years now. But the point here is that sometimes this really myopic focus on scale, I think, can be dangerous because we're innovating so rapidly that potentially we don't understand our own innovations, and the room for impact is maybe not exactly where we thought. So some of this really traditional levels of scaling that we want to see doesn't leave enough room for pivoting and really understanding impact as it comes along. So I guess those are two things that I feel like the investment sector needs to figure out how to buffer against to make us more effective. And I'm just wondering if you guys could talk to that a little bit.
So, other comments? Anyone else from the audience before we turn to our speakers? Yes, over here.
Hi, I'm Akanksha. I'm an entrepreneur, social entrepreneur as well, and I would completely echo, I'm sorry, I've forgotten your name, Alex's thoughts. I mean, we've started to, hedge that we want to raise investment in about a year from now and started mapping the space. And literally, when you learn about the space, you believe there's a difference between an impact investor and an investor, but when you look under the hood of the car, they're basically the same. Mm-hmm. And so, I've had this conversation with multiple investors, including Owen in India, and I'm wondering, and I asked them, so, well, you're an impact investor, so what do you build into my governance laws or into our investment partnership that make social equal to on the agenda as returns? And what happens when these two come into conflict? And then it just gets really wishy-washy. No one has given me an answer to this question. And I hate to, I reference SKS. SKS nearly brought down the microfinance industry in India. And they did exactly that. They scaled really quickly. They did a lot of stuff to pump up their valuation before they went for IPO. And there were no safeguards. And people committed suicide because people were given loans that shouldn't have been given loans to pump up that valuation. So I know we talk about impact investing, but it's a really new space, and I don't think anyone has put down any, safeguards for the social side of this investment space as we talk about all this amazing scale that we're supposed to have.
Comment next to you.
Yeah, Asad Mahmood from Deutsche Bank. Thank you very much. I'm a social investor. I've been doing it for 16 years. I want to address a couple of issues of duplicity that we have in the sector. People that sort of say they're social and they're not. They say they want financing, but they're really businessmen looking for the cheapest funding available. It happens all the time. And there's some people in the room here that have done that to me. So, but there are a couple of issues that I want to talk about. One is collaboration. And then I want to really address this lady's issue because she really brought so many important points with such truth and honesty, which I rarely see in this sector, except for me, that I'm always sticking my neck out and saying controversial things. But first of all, collaborations. My work over 16 years has been nothing but collaboration. All my funds have always centered around working with the largest companies in the world, working with the development sector. And the way I do it is I tell the truth. I never tell them that this is about diversification or this is about this or that. It's really about social. Most of the companies in all AXA, Munich Re, Prudential, MetLife, State Street, Merrill Lynch, they've all invested with Deutsche Bank. And their interest is not diversification. Think about it. These are billion-dollar institutions. If they put $5 million into a fund, is that a diversified portfolio? So the truth needs to be told. This sort of benevolent puffery that is in the sector needs to be, a little bit toned down. It is good to show the shining city. It is great, but talk about that the path ain't dug yet, and it's full of crocodiles.
Yeah.
You know, that
Okay.
sort of element. Now,
All right.
addressing this lady's question as what do social investors do? And I want to show you that they are social investors. And what Andy talked about, this, you know, this singularity, where I have sort of championed and continue to champion the idea that it's not like two different legs. It is one. It's like DNA intertwined. What I have done through my work is I've started putting covenants at the board level. So I have legal documents. So that means if they don't follow this social idea, I can call my loan back. And we have put covenants at the management level that they have to establish a committee that focuses on social customer issues. They're the same thing.
Okay.
Things like that have happened in the industry. So I think there is a movement.
And again, this is the moment we're in, right?
Yeah.
This is the moment the people in the room are in about wrestling with these issues, right? When do you put down a regulation or a covenant, right? When is that appropriate, right? And it's true that people are coming, and under the hood is the same thing. There are pressure with the old model, have the same market returns and call it something else. And there's incredible enthusiasm to scale that has consequence. Let's continue the conversation so we can wrestle with what that takes. Comment in front up here. I'll come back to you next.
Hello, Alfredo Brillenborg, urban think tank founder, doing a lot of work in slums around the world and from architecture and urban design, also the dean of ETH, Eigenosche Technische Hochschule in Zurich, so in architecture.
Okay.
But
busy man.
Yes, well, but I'm just curious because I've heard a lot about, we've heard a lot of this conference about mobile technology, digital cell phone, you know, a lot of that. That's huge, right? That's going to be the next technology. We don't talk about building materials, construction materials. We talk about the cell phone, right? And I know and I believe that we'll get that, you know, a smartphone down to $24 all over Africa. I'm sure about that. So I see a kind of future, this kind of Star Wars, kind of Luke Skywalker, right? He's coming out of a mud hut, but he's got all these technologies available to him, right? But at the same time, we're all talking about money, right? Impact investing, money, and have you guys not thought about that the future might be alternative currencies? You know, Somalia has currencies that have no central bank backing it. So what do you guys think about the app and the mobile phones as trading, but no one's backing that currency?
You were going to comment before. Do you want to comment on that, or do you want to share your thought? Okay, just.
Hi, Jan Piercy from Shore Bank International, and I want to just thank the great tee-up, and there's so much here in the room. But just a quick question. Andrew, when you were citing, and congratulations on getting to 200 million, because I think that really is the largest, if you will, impact investment. And the investors you cited were all private sector investors. I recall in the first round, a role was played by the International Finance Corporation. So I wonder if you would talk a little, because part of the theme here has been, how do we braid together the philanthropic capital, the public interest development finance, and then the private sector? I know there have been structured instruments that can braid them together by looking at their different risk returns. I mean, that's what we did in the BRAC Africa Loan Fund and others. But would you say a little about what that was like to work with those investors and how you've made this transition?
Sure. Well, one of the things we're quite proud of in terms of Fund 2 and Fund 1 is that we have right from development finance institutions such as the European Investment Bank, FMO, DEG, and CDC through to the more commercial players. So in Swiss Re, it comes out of their private equity allocation. And we have taken a view that you shouldn't be ideological in the sense that saying, you know, it only comes from this player. What you have to do is be able to show whatever point in the spectrum people care about, their mix of risk and return, or of, in particular, of social and financial, that you can provide a product that outperforms at that point. And part of that is by coming up with metrics for quality, affordable, relevant products that are going to appeal to a big reinsurer and insurer that wants to see a 10-year horizon, or a 50-year horizon for that matter, with reinsurers, of these products being sold to billions of people. And part of it is coming up with metrics for quality, affordable, relevant products that people who are entirely concerned with the social can say this really works for the customer. But in the end, of course, there are trade-offs. You can always add 10 cents more or less to a product. But the fundamental question is that product something that's providing quality and affordable value to the customer? So if you're really product focused, there isn't an ideology around return, right? If someone is serving 100 million people and making $5 each time they do that, they're making $500 million, but those 100 million people are rising out of poverty because they finally have protection for their assets and the ability to take leaps, and they're going to make $500 million out of that. May that be the future, frankly, compared to the people who currently make $500 million. It's a long, long way from that. I hope some of the early stage entrepreneurs in the room are the people who do, social entrepreneurs are the people who do that. But we do need to think at scale because 4 billion people in poverty do not have time to waste. We do need the highly scalable, highly financially possible interventions that are going to get significant capital behind them and reshape these markets. Otherwise, people are going to die.
Yeah.
Unnecessarily.
And so that's about the returns. Can you speak to this question before, though, around how do we have the protections on the social end for the entrepreneur?
Absolutely.
And knowing there's valid criticism that it's not unfinished, we haven't figured that out. So where are we in figuring that piece out?
We're all working on that, and I'll hand over to Matt in a sec. But just to say, I think Assad's approach at Deutsche Bank is a very powerful one, and it's one we've adopted as well, which is covenants in legal documents and, frankly, also in the KPIs annually of the entrepreneur, the social entrepreneur, the entrepreneur, and of the leadership team to show that if they're not achieving certain social results, they're not going to get their bonuses, they're not going to get paid. What typically happens is they get incentivized on the commercial and then they get checked on the social. And that's not the way to go. The way to go is to say these are the set of KPIs that are going to get you outperforming and the business outperforming from both a financial and a social perspective. These are the KPIs that are going to create the synergy. And if you're delivering X number of products and getting great revenue, great, but you're not going to get any pay for that unless those products are really shaping those customers' lives.
Matt, do you want to add to that?
A couple points. I want to also address the comment from the gentleman from Mexico. There are a lot of people who, U.S. foundations who, in particular, who fund a lot of do a lot of grant funding. There are a lot of private, and that's about a $40 billion annual pool of capital. 99% of that goes to grants. A lot of foundations are talking about doing impact investing. It's of that 1% that's not grants, only 5% of that goes to impact investing. So 1/100% of foundation dollars currently are going to impact investing. We think that should increase. One of the reasons that foundations focus on grants is they think impact investing is risky. We point out that grants are guaranteed 100% loss of principal. So we would encourage more impact investing. It's gone from 5/100% to 7/100%. Then there's the other part of the capital curve, which are people who are driven primarily by financial return. And as was pointed out, a lot of those folks are saying, we care about social impact, but they aren't willing to take greater risk or a lower return to actually support businesses that actually might drive substantial social impact. So I think the capital curve, we have barbells, right? We have a lot of grants available, we have a lot of capital pursuing risk-adjusted financial returns. The reality is, if you want sectors to really scale, you need to invest early stage, high risk, to get the business models proven out so that then commercial capital can come in and take them to massive scale. So I think you're pointing out a really, really important gap. Now over here, thank you guys for the provocative comments. I think they're well taken. Our approach in terms of, because there is potentially, our approach first is to only invest in organizations that we think can have fabulous social impact. So that's right up front. And then we say, okay, based on that social impact, we will invest across the returns continuum, from grants to solid financial returns businesses. The social impact is the first screen. Now, one can worry about mission drift, right? If a firm you invest in is having great returns, how do you keep them from maximizing the financial returns and therefore subverting the social impact? One approach is to put it in contractually. Our approach is to make sure you have really good founders and management and that you trust them and that you have representative on the board so that you're in those board conversations when you have those conversations about a trade-off between price and scale, for instance. So legally putting things in is an important thing, But I have confidence because I've invested in firms led by Tracy and by Andrew, and I don't need to tie them up with a lot of extra legalese.
Okay. Question back here. Yep. It's coming around to you. Then I'll come up front.
I just have a quick question, and I don't know if it's necessarily fully relevant, but what do you think about the new model, the benefit corporation type model, and the new legislation that was passed in Delaware that looks at hybrid kinds of models for businesses? I'm just curious if anyone here has opinions on that as an alternative as well.
You want to take up that question? Over here?
I'll take up that question as an opportunity to ask my question. So as a social entrepreneur, benefit corporation is just a codification of rights that you have under a regular C corporation. And, you know, it's good if you want to join the movement of changing what fiduciary responsibility is to your investors. My question is, I'm a social entrepreneur, so I want to keep hammering on this early stage capital issue, which now I'm the third person that's raised. I heard in your question not an issue around measuring impact, but an issue around the amount of risk-tolerant capital that's available. So just to respond to what you just said, Matt, is there a silver bullet? I mean, Ronald Cohen talked last night at the event, Tracy, about venture capital in the 1970s, $30 million in 1971, ERISA legislation changed, and then it quadrupled to $100 million 4 or 5 years later. What can be done in terms of policy to move early-stage risk-tolerant capital from whether it's philanthropies or other organizations to early-stage entrepreneurs such as myself?
Is someone going to answer this question? We got new questions. Let's stay on this. You want to take that point? Yeah.
Yep. My name is Jochen Wehrmuth. We founded the Green Gateway Fund. I think this is a key point. For me, impact investing, you focus so far only on social, but there's also other impacts. Like Green Gateway Fund does anything we do has to have a positive environmental impact. What I really don't understand, I understand people who do good and they don't care to lose their money, that's philanthropy. What I really don't get is how we have 99.9% of world's investments in what I call the vice fund quadrant, right? People that consciously invest in stuff that either is trades, sex trade or whatever it is, they're actually vice funds. The majority of all the investments of each of our pension money, our insurance money, is going to vice funds. People who think that if I clear cut a whole hillside and I make a profit, that's good. Complete nonsense. So I think we as the beneficiaries of insurance companies and pension funds have to give them very explicit mandates to invest in first-time funds, in first-time early-stage companies. Legally, we have to make that distinction, and I think it's possible. If you go to speak to PGGM, which is a great company in Holland, right, and AGP, you say, we do impact investing. When you go see them, what do they tell you? I said, well, we invest in KKR 15. I said, why? Well, you got to have a track record. Well, yes, but we're doing new things. We're building a new economy, a circular economy model. So you got to go as individuals, as clients, and
so what else is going to release the early risk capital? That's the question we're focused on now. Do you want to take that? Right.
Here you go.
I think a missing link in our discussion is
so you're not talking about the risk capital. We'll come back to you. I want to stay on that question for a minute. We'll come back to your prompt.
But no, it actually addresses that, because I think we're missing a piece of the puzzle, which is the intermediaries in the ecosystem, right? So we're talking about entrepreneurs, we're talking about impact investors, but we're not talking about the institutions that are actually bringing these two together. I'm talking about seed accelerators, incubators, second stage accelerators. Right. And I think here is where you can really solve the puzzle, because if you...
So what's the bottleneck there? What do you think the bottleneck is to...
I think there's no dialogue. I'm a board member to the National Business Incubation Association, and there's absolutely no dialogue between impact investment and the incubation community. The dialogue is not there. Mm-hmm. So the impact investment asset class is trying to reinvent the wheel, and we're talking about there's no pipeline, there are not enough opportunities to invest in scalable businesses. Mm-hmm. There is a pipeline, and the pipeline has been building up for years and years. We just haven't been talking to the right people. And to the risk profile, I think the ecosystem has already sorted out a system to funnel and to incubate the right and to put in touch the right investors with the right company. So I think there's a missing link there. And we're just not leveraging the existing infrastructure in the ecosystem. I think that's very important.
Great. We have a question up here. It's interesting to think about because some people are looking very hard for deals. And so the fact that they're hidden is an interesting idea to play with. So what's going to unhide them? Is that true? Yeah.
Hi, Asachi Shinoy from Upaya Social Ventures. This is actually more of a response to our entrepreneurs and building on what Fernando said. I wanted to throw out an idea for the audience, and it's something that we've been trying to do for the last 3 years, and that is we talk about philanthropy on one hand, and then we talk about for-profit capital on the other, like they're two completely separate and distinct things. One thing that we are doing, and we're seeing a lot of success with, is taking donor dollars, philanthropic capital, investing it as patient equity in early stage entrepreneurs. And this is a win-win situation. Philanthropic capital, like somebody else pointed out, is the best form of risk capital. This is exactly the kind of capital that entrepreneurs need in the earliest stages. You're at an early stage and you're not at the point where you can prove that something scales. You need to be able to prototype and have someone who's going to be patient enough to prototype with you to prove that it can scale. But if it's philanthropic capital that's being invested as equity, you are already inculcating market discipline from the get-go. It's not just a grant that can be wasted. At the same time, you are giving them a longer time horizon, and for the few that do pop, you get a return on donor dollars, which can then be recycled. And so I just see that as a win-win, and I just want to know why we're not seeing more of that.
Okay. Comment up here. There's a sort of movement that the giving pledge was a mistake. It should have been the impact pledge, right? Which is part of that idea.
I'm Jesper Snoek from Doen Foundation. We're a social investor. We support alternative currencies, incubators, and a lot of social enterprises. I really like your comment, and I like Matt's comment. I think what really should help a lot, and what we also try to do, is we could come in with grants at a very early stage, at a very high risk early stage. We could continue with loans, and we could, at the last stage, take equity stakes or a mix of those. I think Matt does the same with the Omidyar network. And I think this is really a model that could also, for the philanthropic people around here, could be very interesting just to test an idea, see if it works, if it scales, if it shows some perspective. You can come in with other instruments. You lower your risks, you can get involved, and if it doesn't work out after this initial stage, focus on something else. So I really think that's a model that can sort of help everybody to take the next step. And in our case, it proves to be very successful and very interesting, very fun.
Thanks. There's a comment right behind you.
I'm Chet Tzeski, the founder of the Global Green Grants Fund, and also a new fund, the Sustainable Development Strategies Fund. I'm also a board member of the Council on Foundations, and I want to be clear that my following comments don't reflect the Council's position on this. And when you hear them, you won't be surprised to hear that. Here's two ideas that I think could help open up impact investing and address this question of philanthropic resources. And one is to stop counting PRIs or impact investments in the 5% payout requirement. Matt talked about the very small percentage that it equals, but nevertheless, in some foundations, it's growing quite large and reducing the grant budget, which is not a good thing. Second, and more important, I think that we should, as a sector, start to voluntarily also commit 5% to impact investment on top of the 5% payout. And that would immediately mobilize $40 billion that's currently off the table. And it would also be a sign to Congress that this sector is interested in making a bigger contribution than it's made in the past, so that this kind of thing doesn't become mandatory.
So when you're sitting in your role that this is not speaking from, what's the feedback you get? What is the pushback? Because everyone in this room probably thinks that's a good idea. So what are the constraints we're up against to make that happen?
Well, there's been plenty of pushback to the idea that payout should be increased by 1% or 2% for 20 years. So this is a compromise solution, I think. If we don't increase payout requirements, then let's at least voluntarily increase impact investment.
Okay, great. There's a comment of a gentleman sitting right next to you.
Hey everyone, my name is Kareem Abelnaga with an organization called Practice Makes Perfect. We just went through an accelerator ourselves. I'm also a social entrepreneur, and one of the things that they're experimenting now is taking a percentage on earned income. So if you have a revenue model as a nonprofit, they'll take 2% and share in that. I think it's an interesting idea to continue to experiment with. The part that really hurt us through the accelerator was that the players were foundations, and foundations don't tend to be as excited about a philanthropic investment as they do when they have more skin in the game. So how do we get more people excited about these philanthropic investments, even in an earned income model?
Comment back here. Okay, we'll come back to him. There are a bunch of people waving. We'll come back there next. There's a lot of people waving.
Hi, Manuel from Mexico. Since today it's about being provocative, sort of this whole thing we were talking about how the impact investment fund is really just an investment fund with the new name. It also happens with entrepreneurs. So it's like, so I'm a social entrepreneur instead of being a normal entrepreneur. So sort of the same thing. You know, you have this chewing gum company in Mexico that has 5% ingredients from a Mayan community. Now they're a social entrepreneur. So sort of this whole impact investing and social entrepreneurship scene, is it really, well, my opinion is companies have to be socially, environmentally, and economically responsible, and so do funds. So right now it's okay to overcompensate. I was reading an article on, is Google the largest social enterprise in the world? Probably yes, has huge impact, gets information to lots of people, all this stuff. So will it eventually be the same thing, and we won't be talking about, oh, I have social impact, so now I'm sexy, so now you invest in me? Or is it just like, eventually going to become the same thing because it's the companies and the fund's responsibility to do.
And it's a fundamental question of where's the sexy standards going to come from, right? Who's going to define that? Yes, I know you've been waiting in the back. Thank you.
Yeah, hi, I'm Martin Fisher from Kickstart, selling irrigation pumps across Africa.
You got to hold the mic up.
And I think when we talk about risk capital, yes, absolutely, philanthropy is the best risk capital. And somebody asked a question here, well, why don't we have more people looking at it that way, and can we do equity? And one problem there is, of course, is that nonprofits, you can't take equity in. But I think the bigger point I want to make is that social entrepreneurs are out there trying to tackle some of the biggest, hardest problems in the world. You know, extreme poverty, healthcare, education. And these problems exist because of fundamental market failures, right? That's why the problems are there. The markets simply don't work to reach the very poorest people to solve those hardest problems. And so we absolutely need a subsidy, which is philanthropy, in order to change and overcome a market failure. And that may take many years before you can get an investable organization. And I think that's where we fail to see in this impact investing, is we saying, look, let's come in and look at the case of microfinance, which actually took 30 years and hundreds of millions of dollars of philanthropy investment before it got to the point where it was investable. Yeah. And it's going to take the same for other things.
Okay. Matt, do you want to make a comment?
Just had two quick comments. First of all, source of philanthropic capital. High net worth individuals is a huge potential source. The numbers are staggering. Giving Pledge, about 90 members, cumulatively control $500 billion of net worth, right? And these are people who have committed to giving away 50% of that in their lifetime, right? Go more broadly, the Forbes 400, $2 trillion of net worth. So there's a really interesting pool of capital to think about. One final point. So Ronnie Cohen, who's a leading investor in the UK and considered the father of venture capital in the UK and a founder of the concept of the social impact bonds, has been tasked with a G8 to lead a task force that is looking at impact investing. And I'm the private sector representative from the US. Tracy is co-chairing the National Advisory Board. And we are very much interested in, and I say this with certain trepidation on email volume, very much interested in hearing from people on recommendations that we can collate and forward to the G8 governments and how we can advance impact investing in a responsible way. So my email is mbannick@omidyar.com. And if you have fabulous ideas that you want to input into the G8 process, I'm not going to give away your email address, Tracy. I'm welcome to hear, very welcome and encouraged to hear from you.
There's a comment in the middle here. Yep. I'll come to you next.
Hi, my name is Jill Iskall, and I'm the author of a book called Hearts on Fire, Stories of Today's Visionaries Igniting Idealism into Action. And I am on the board of Acumen Fund as well, and have been around the block and back again in the not-for-profit sector. And I just want to say one comment in support of your comment, and also praise all of you for this incredible discussion, because I think unpacking the issues is probably the most important thing we could be doing. The context I want to talk about, just for a second, is that in the 70s, Frank Thomas was the head of the Ford Foundation. And at that time, right, Jan? And at that time, I quote him all the time. He said that philanthropy, foundations, high net worth individuals who have small family foundations or large ones should be the R&D branch of society. And I want to remind everybody that Head Start started from private philanthropy, and when we had the data, it was fed into the policy loop and government came in. I subsequently ran into Frank a few years ago, and I said to him, I quote you all the time. And he said, here's another one for you. He said, philanthropy, big foundations, take more risk nowadays with their portfolio money than they do with their program money. So just an addendum to everything that's been said.
Okay. Right. Comment in the front row up here.
So my comment is about exits. So we talked a lot about the beginning of part of the investment, about risk, adjusting the risk. But I think one of the things that would accelerate this sector greatly is if you have a shining example of an exit, which not only boasts financial returns, but social returns. But I guess it's really, really hard to do both. So I guess my question is, what would be considered a very successful exit? Because as a social entrepreneur, you want to scale, but you have the option of going deep and really not scaling but solving a hard social problem, or you try to scale. And doing that requires partnerships with either corporations that will eventually swallow you. Is that acquisition a successful exit? Or you keep raising money from a lot of investors and grow an IPO, and like Compartamos and SKS, but that might change the way your mission works and your social aspect of the business. So I guess I wanted to open up to the floor to what is a successful exit for this sector, and how would it prove the point that this sector is actually something that's worth investing for everybody?
Good question. We're going to have to come and begin to wrap this up. And so I'm going to ask the speakers in a moment to come back with some final thoughts. But before that, we have a tradition at CGI of hearing from commitment makers who are working in this space. So I'm going to ask you to share your commitments, and we'll come back for some final thoughts.
Hello, I'm Per Molin from Swedbank, and this is my business partner Björn Larsson from the Foresight Group. We decided to do our commitments differently, and we have 3 messages on our passionate investment approach. First, we will contribute to leveraging and scaling a select number of CGI commitments that have already proved to be working well, and not to start any new investment programs of our own. Second, we will engage the right investors. Therefore, we recruit among Swedbank's top segment private clients against a set criteria.
And the criteria are, we look for genuine humanists and not for brand builders only. We look for those who are still curious and are dedicating to offer some of their time. Together, we explore individual passions and how to put individual personal strengths, wealth, talents, and networks to use to the benefit of others. And finally, to scale this, we will in the future open the successful investments made for Swedbank's 10 million retail clients. Thank you.
That's great.
Hi, my name is Neil Ghosh, SNB USA, and we are equally excited like Matt and the colleague about impact investing. So we have several commitments at CGI, but the one I'm really excited about is the one I'm going to give you a quick brief. It's we focused on impact investing to really develop capacity at the local level, reduce poverty, and also create access to finance. And 3 years ago, we decided to team up with the DFID, Danida, Ford Foundation, and HIVOS to create Zimbabwe Agriculture Development Trust. And fast forward, currently I think we have given out around 120 loans, and this has increased livelihood of around 25,000 people. What remarkable is the repayment rate is around 86%. And the livelihood of around increased of these smallholder farmers is by 40%. And one particular individual comes to my mind. His name is Bright. He grew up as an orphan and dropped out of his school. And because of this particular system and the help he received, he learned how to sell his bananas at a fair price in the market. And what has subsequently happened, his income right now is around $6,000 per year. And what he has done with that money, he saved it, he bought a house, he sent his wife and his niece to school, and is employing 2 people. Okay, one step farther, his village got excited. So 40 of the people in the same village now trying to farm bananas. So our hope that we are currently reached around 25,000 people in the last 3 years. I hope to increase this fund in the next by 2015 and reach out to around 55,000 farmers, in particular this project. Thanks.
Good afternoon. I've really enjoyed the discussion and, of course, the commitments. It's clear from all of the discussions this week that global sustainability challenges of all kinds are really affecting the landscape for competitiveness for business. And no longer can companies really maximize, companies of any kind can maximize financial capital at the expense of environmental and social capital. And yet we don't have a good way yet to measure those other forms of capital. My name is Jean Rogers, and I'm the founder and the executive director of the Sustainability Accounting Standards Board, or SASB. We set standards for publicly listed companies to disclose their material sustainability factors, environmental, social, and governance factors in their mandatory filings to the Securities and Exchange Commission. We released our first standards for 6 industries in healthcare just recently, and we're on track to complete standards for more than 80 industries over the next 2.5 years. Our standards enable investors in the mainstream capital markets to compare performance on critical dimensions of sustainability, and having this information in the public eye creates a race to the top. So our commitment is around not just developing the standards, but helping companies to use the standards. We are partnered with Bloomberg LP, and we're very proud to be launching our corporate pilot program to help companies to use SASB standards. There's over 14,000 publicly listed companies in the capital markets, all of whom should be measuring and managing their environmental and social impacts. In just the past year, we've had 850 companies involved in our standard setting process. 12 trillion in assets under management, investors that have been at the table, 5 trillion in market cap for companies that have been at the table. And these are the companies that we'll be working with to adopt using these standards. Imagine the result when our capital markets are able to account for all forms of capital, and when investors are able to understand the full impact of their investments, not just the 5% giveaway or the 5% you're going to put on top of that, but the 90% of investments that are sitting in equities. This is the vision that we have, that anyone could type in a ticker and pull up sustainability fundamentals right alongside financial fundamentals and make informed investment decisions. And that's the vision we'll be working to achieve, and I look forward to coming back and telling you how we do 2 years from now.
So I've asked all of the commitment makers just to stay here at the front of the room, so if you want to find out or learn more, connect with them, they'll stay here for a few minutes afterwards. I want to ask you to give any closing thoughts, either from conversation or anything else, as a way to wrap up the session.
Just a couple quick thoughts. Thank you, Alexander, for a very well-moderated session. Fabulous. And thanks to CGI for this format. Right, it's terrific. And thank you all for your incredible level of engagement. There are a lot of really meaty topics that went out there in a very candid way. And sometimes that we can get so focused on building the sector that we get a little carried away with the hype. And I think what a lot of you did today is bring it down to reality and how do we actually make this happen in a constructive way. And so I think the discussion, the debate, the disagreements, this is all welcome, and I really want to make sure we continue to have those as we try and build towards an objective that we share. We may have different opinions, but I think we share an objective of tapping the power of markets to drive a bigger positive impact in the world. So it was a great dialogue. Thank you so much for your openness, and I would encourage the same level of candor in all of our conversations.
I just wanted to say that I think if we think of the things we have in common, we really are trying to change the way individuals, institutions, and societies invest. And I really encourage people, again, to have a diversity of views, but also to accept that the place you find in the capital markets may not be the ideal place for someone else. Just like some people like venture capital, some people like private equity, some people like environmental, some people like social, some people like the combination of the two. So we are going to see a number of institutions, some devoted to early stage investing, some to later stage investing. some that are focused on Africa, Asia, some that are focused on the US and UK. And rather than battle each other out for what's the one true way, I would encourage people to learn from each other to get to a point that we all agree with, where we want, you spoke about Google as social enterprise. Let's see these social businesses, the likes of Aldi, go to being of that enormous scale. Let's see a different kind of capitalism. You may be helping at this point, or this point in their evolution, but regardless, what you're doing is you're creating a more catalytic form of capitalism, and you're probably having a massive impact on poverty and the way we practice business.
Picking up on that excellent comment that Jill said, which is the conception that philanthropy uses grant dollars to provide the R&D in the laboratory to refine innovations, and then handing it off to government to use sweeping policy change to affect lots of people, and that's kind of the takeoff for philanthropy. I just wanted to have a sobering comment that we're living in an unprecedented phase of tremendous fiscal constraints, that the pressures on our public dollars is never been this dire before, and that this conception that government could just very quickly pick up the innovations that foundations have perfected to affect through policy is more and more challenging going forward. So I would beg all of us to think creatively about new models, to challenge the traditional social contract, to think about new sectors working together and feel very comfortable about mixing profit with purpose, and to bust these silos. And all of this requires a very different kind of mindset. And the last thing I would say is that in addition to talking amongst one another, which is a room full of fellow travelers, I urge everyone to go out and talk to the people who actually want to disagree with us. We want to stretch this community, grow this community, and bring more converts to the conversation.
So thank you, everyone, both for this conversation and pushing this work forward. Continue to work together, learn together, wrestle. Thank you very much.